If you're a US citizen or green card holder living outside the United States, there's one dangerous assumption that can cost you badly. Because I live overseas, the IRS probably won't notice. That may have been easier to believe years ago, but today the IRS receives information from banks, brokers, payment platforms, foreign financial institutions, and tax reporting systems around the world. So in this video, I will walk you through 5 IRS audit red flags for Americans living abroad, and more importantly, what you should review before the IRS contacts you first. This is general tax education only. It is not legal or tax advice for your specific situation. Speak with a qualified tax professional before making any decisions. The first red flag is one of the most common: income mismatches. The IRS has an automated underreporter system. In simple terms, it compares what you report on your tax return against information reported by third parties like employers, banks, brokers, retirement custodians, and payment platforms. For expats, this can create a very specific problem. You may correctly report foreign earned income and then claim the foreign earned income exclusion on Form 2555, or you may claim a foreign tax credit on Form 1116. But the IRS matching system may still see a Form W-2, Form 1099, or brokerage report and think, wait, this income was reported to us, but we don't see it properly taxed. That can trigger a CP 2000 notice. A CP 2000 is not technically a full audit. It is a proposed adjustment, but if you ignore it, it can become a serious tax problem. Common expat mismatch examples include: number one, U.S. wages reported on a W-2 but excluded on Form 2555. Number two, U.S. brokerage income reported on Forms 1099 DIV, 1099 INT, or 1099B but not reconciled properly. Number three, IRA or 401k distributions reported on Form 1099-R, especially where a treaty position is involved. Number four, crypto activity where transactions are not reported correctly. And number five, payment platform income reported on Form 1099-K. The key lesson here is simple. Do not only report the final taxable amount. Make sure the return tells the full story. If the IRS receives a form showing income, your return should clearly reconcile that income. The second red flag is foreign account reporting. Many Americans overseas know about the FBAR, FinCEN Form 114, but not everyone understands that FBAR is separate from Form 8938. The FBAR is filed separately through FinCEN. Form 8938 is attached to your U.S. tax return. And this is where problems happen. You may have foreign bank accounts, investment accounts, pension accounts, or accounts where you only have signature authority. Some may need to be reported on the FBAR. Some may also need to be reported on Form 8938. The rules are not identical. An IRS red flag can appear when your foreign account reporting does not line up with your income reporting. For example, imagine an expat reports large foreign account balances on an FBAR, but their Form 1040 shows little or no foreign interest, dividends, or investment income. That mismatch can raise a question. Are these accounts producing income that was not reported? Another common issue is answering no on Schedule B when the taxpayer actually had foreign financial accounts. That is a dangerous mistake. FBAR penalties can be severe, especially if the IRS believes the failure was willful or reckless. And the problem is not only the account balance. The IRS may also look at whether income from those accounts was properly reported. So, the key takeaway is this: your FBAR, Form 8938, Schedule B, and Form 1040 should tell one consistent story. The third red flag is one that catches many expats by surprise: foreign gifts and inheritances. Many people think it was only a gift from my parents. It was an inheritance. It was not an income, so I don't need to report it. That thinking can be costly. A foreign gift or inheritance may not be taxable income, but it may still trigger a U.S. reporting obligation. For example, certain large gifts or inheritances from a non-resident alien individual or foreign estate may need to be reported on Form 3520. And if foreign trusts are involved, including certain foreign pension or investment structures, Form 3520 or Form 3520A may become relevant. The penalties for missing these forms can be very high, even when no U.S. income tax was due. This is why I always tell expats: do not confuse not taxable with not reportable. Those are two different questions. The fourth red flag is PFICs, passive foreign investment companies. This is one of the most misunderstood areas of U.S. tax for Americans abroad. Many expats invest locally. That might mean Australian managed funds, foreign mutual funds, non-US ETFs, unit trusts, or investment-linked insurance products. To the local country, these may look completely normal, but for US tax purposes, many of these can be treated as PFICs. PFICs are a compliance trap because they may require Form 8621. And Form 8621 is not a simple form. The tax treatment can also be harsh if the taxpayer has not made a proper election. The default PFIC regime can result in punitive tax calculations, interest charges, and very complicated reporting. Even worse, missing Form 8621 can keep part of the tax return open to IRS review for much longer. So, if you are a US person living abroad and you own non-US pooled investments, do not assume they are treated like ordinary investments on your US tax return. Before buying funds, get US tax advice. This is not an area where you want to guess. The fifth red flag is claiming the foreign earned income exclusion or foreign tax credit incorrectly. Many expats know they may be able to use Form 2555 to exclude foreign earned income. Others use Form 1116 to claim a foreign tax credit, but these are not automatic. For the foreign earned income exclusion, you generally need a foreign tax home, and you must meet either the physical presence test or the bona fide residence test. That means the IRS may look at your travel days, passport records, visa status, employment arrangement, and whether your real economic and personal ties are actually outside the United States. Remote workers can be especially vulnerable. If you work remotely from another country for a US employer, you need to carefully review where the income is sourced, whether you qualify for the exclusion, and whether foreign tax credits are being calculated correctly. And if you own or operate a foreign company, the risk can go even higher. Foreign corporations, foreign partnerships, foreign disregarded entities, and foreign owned US companies can trigger additional forms. And some of these forms carry large penalties if missed. The key lesson is this: the more international your facts are, the less you should rely on basic tax software alone. Here's what to do before the IRS contacts you. If you are an American living abroad, review these 5 areas before the IRS contacts you. Number 1, did you report all income that may also be reported to the IRS on W-2s, 1099s, brokerage statements, or crypto records? Number 2, do your FBAR, Form 8938, Schedule B, and tax return all match? Number 3, did you receive large foreign gifts, inheritance, or trust distributions? Number 4, do you own foreign mutual funds, ETFs, unit trusts, or managed funds that may be PFICs? Number 5, are your foreign earned income exclusion, foreign tax credit, remote work, and foreign entity filings properly supported? If you discover a problem before the IRS contacts you, there may be correction options available. But once the IRS contacts you, some options may no longer available. If you're a US citizen or green card holder living abroad, and you are unsure whether your US tax filings are complete, this is exactly the issue that you should review before it becomes an IRS notice. If you need help with your US tax filings, book a consultation with us. Email us at hello@usautax.com.